I'm Nick Brind and I'm joined by George Barrow, and we are two of the three co-fund managers of the Polar Capital Global Financial Trust. On slide 3 you see the three strategies we manage. The Polar Capital Global Financial Trust was launched in 2013 with an income and growth mandate to offer broad global exposure to the global financial sector. On slide 4 you can see examples of companies we own across the bank sector, insurance and others. So these include large banks such as JP Morgan and TD of Canada, smaller banks such as East West Bank, a Californian-based bank, and One Savings Bank or OSB Group. Insurance companies include Chubb and Arch, both based in the US, and other companies include companies such as MasterCard and Blackstone, the latter being an alternative asset manager. On this slide we show performance of the trust since inception in 2013 and the corporate action in April 2020, when the trust's life was extended indefinitely subject to regular tenders, the next to be held in June 2025. We show performance against our benchmark, the MSCI Acqui Financials, the Lipper open-ended peer group of financial funds, a selection of UK banks and wider equity indices. Why invest in financials now? 5 key points. They remain attractively valued in absolute and relative terms relative to wider equity markets. They remain beneficiaries of reopening trade or any rotation into value out of growth stocks. Capital return is accelerated as any restrictions on bank dividends and buybacks has been lifted by regulators. The sectors are beneficiary of higher interest rates and bond yields, and further out there are structural growth drivers in emerging markets, small and mid-cap banks and fintech. The performance of banks over the pandemic is shown on the right-hand slide versus that of the GFC 12 years ago. Banks have underperformed by more during the pandemic than they did during the financial crisis, despite much stronger capital, liquidity and lower risk appetite. We see this as an opportunity. The sharp fall in bank shares back in 2020 was driven by a concern that there would be a jump in defaults by companies and individuals as the lockdowns imposed by governments in reaction to the pandemic resulted obviously in a sharp fall in economies and rise in unemployment. As seen on the chart on the left-hand side, the rise in bad debts was much less than that, rising to barely a fifth of what was seen in the GFC as a consequence of central banks cutting interest rates and undertaking further quantitative easing, stimulus by governments, and also the lower risk appetite banks entered the downturn. On the right we show against this, banks took huge provisions in expectation that the downturn would be significant and long-lasting. Over recent quarters, banks have been releasing some of these provisions through their profit and loss account, resulting in strong earnings as they've proven to be too prudent. Today, banks still hold higher levels of provisions than they did when they entered the pandemic back at the end of 2019. Key, obviously, driver of the sector going forward is the outlook for inflation, bond yields and interest rates. At the end of 2021, central banks pivoted when they saw that inflation was proving less transitory than expected and much more durable. As you can see on the chart on the left here on slide 10, bond yields have risen sharply and yet still remain well south of where inflation expectations and bond yields have reached. And that rally has been beneficial for the sector, which we'll touch on over the next couple of pages. The 2-year, 10-year US government bond yield curve has inverted, raising risks of recession, albeit it has given some false signals in the past, and therefore we must be cognizant of that. Banks are very sensitive to interest rates. Today, they are more sensitive to rising interest rates than they were 2 or more years ago, due to the influx of deposits into the banking system as a consequence of quantitative easing and government stimulus over the last couple of years. As interest rates rise, there is less competition for banks to pass on the increases to their depositors. Consequently, all things being equal, as you can see on the left, a 1% increase in US interest rates results in around an 18% in US banks' earnings in year 1. As not all loans reprice in that first year, then US banks' earnings will rise further in the following years after interest rates rise. On the right-hand side, we show how banks in different regions are sensitive to rising rates. In Europe, banks are more sensitive, reflecting their lower profitability, so the improvement in margins has a bigger impact, but also they have a higher preponderance of floating rate loans on their balance sheet versus the US or Australia and Canada. Leading on to slide 12, this results in banks being one of the most sensitive sector to rising bond yields, but also insurance. This relationship has broken down partly in recent weeks on the back of the war in Ukraine, but longer term, if bond yields and interest rates continue to rise, we'd expect the sector to benefit from that and therefore outperform wider equity indices. On the right, we show the correlation of banks to other sectors, and reflecting that correlation to bond yields, banks and other financials do provide some diversification benefits against higher growth sectors, which have benefited from low interest rates over the last 5+ years. On slide 13, we show the impact of much higher inflation, looking at data for the performance of UK banks in the 1970s. It is worth bearing in mind that the data is mixed. As a consequence of events that happened in the 1970s may not be replicated currently, but it does suggest that financials are one of the relative winners. At the end of the 1970s, also, the incoming Conservative government put a windfall tax on the banking system, seeing it as one of the beneficiaries of rising rates, and it had generated windfall profits.
So turning to slide 14, looking at the macro outlook, there are a number of factors out there that have raised the level of risk and reduced visibility. We are seeing a moderation in growth and a supply-driven inflation shock related to Ukraine. But while we acknowledge a more uncertain environment, a recession is not our base case. Monetary policy is normalising, but still real rates remain negative and highly stimulative. The labour market is strong and saving rates are high. US households have built up an additional $2.1 trillion savings during COVID, equivalent to $17,000 extra per household. As the charts highlight on this slide, we can see strong strength in terms of US household balance sheets and currently at low debt servicing ratios. Similarly, on the corporate side, we expect support from high cash balances to feed through into increased capex. So certainly a more challenging environment as uncertainty related to Ukraine remains high, but fundamentally a backdrop of normalising monetary policy, reasonable levels of growth remain supportive for the sector and for banks. Turning to balance sheets on slide 15, key message is that capital is significantly stronger than it was during the last cycle. Importantly, banks have continued to build capital during the pandemic. A key difference to the financial crisis is that we now have clarity in terms of the regulatory outlook, and that feeds through into a much stronger capital return outlook, as we'll see on the following slide. So turning to capital return on page 16, we expect it to be a key support for the sector. Looking at US banks on the left-hand chart, expected to average around 7% total yield if you include both buybacks and dividends. In terms of European banks, we expect also a high level of capital return as excess capital levels are run down. Importantly, we've had a statement from the ECB that they are comfortable in terms of the capital return plans outlined by European banks. They view Russian and Ukrainian risk as contained, and therefore the risk of a blanket ban on dividends has been removed. So on page 17, we've highlighted loan growth for our US small mid-cap banks, which averaged 26% or 30% on an underlying basis, excluding PPP loans. We wanted to highlight the strong levels of growth in this particular segment, which is also particularly sensitive to higher rates, given its revenue mix. This remains a key overweight for the trust. So turning to valuations on page 18, this chart looks at the correlation between the starting price to book in global banks and the forward 3-year returns. The current price to book multiple, which is the orange dot, is around 1.1 times book. History suggests around 35% forward returns from this level. So while banks have seen a recovery, they're only back to their pre-COVID lows in terms of relative valuations. And whilst we have seen some earnings cuts recently, the movements in bank share prices has more than discounted this. And we think now offer compelling risk reward at this point, with the sector expected to see strong support to earnings from higher interest rates. In terms of insurance on page 19, it's the second largest subsector in the trust at around 22%. We've been raising our non-life exposure recently, given its more defensive characteristics and in recognition of a more uncertain environment. So we are overweight non-life insurance, but underweight the insurance segment overall, given our more limited exposure to the life sector. There is some uncertainty surrounding potential non-life losses over Russia-Ukraine, primarily related to Lloyd's vehicles, with which we have a small exposure at the moment, but it's expected to be an earnings issue rather than acquiring additional capital. So overall, the sector is benefiting from a hardening rate environment as highlighted on the chart. Following chart highlights the extent to which growth has outperformed in the last 15 years or so during a time of declining and low interest rates. We are now back to the dot-com era, and in terms of the recent rotation into value, it has only put a slight change in terms of the graph trend. We think there is some way to go should we continue to transition to a higher inflation and higher interest rate environment. Following slide gives a quick summary of the holdings. Whilst we have recently reduced banks and added to more defensive sectors given a reduced visibility on the outlook, the banking sector remains the key overweight and is around 60% of the trust. The US remains the largest geographic exposure at around 50%, and when we view lower impact from the ongoing crisis in Eastern Europe. We've reduced our emerging market exposure in the last year to around 15% of the trust. It was around 27% at its peak at the back end of 2020, but still the large majority of our emerging market exposure remains within Asia. Our UK exposure at 11% is slightly higher than it has been historically. We're unlikely to raise it materially from these levels to give global diversification to investors, which we think is very important when investing in the sector. So in summary, we recognise that risks have increased and the growth outlook has moderated, but we still remain constructive on the sector and view a compelling valuation opportunity in the banking sector, which offers attractive yields and strong earnings gearing to rising rates. As seen during the pandemic, the level of risk on banks' balance sheets is materially lower than seen during the financial crisis. Capital levels are higher and regulatory risk is meaningfully lower. We do not see this combination of factors reflected in current valuations, which we think offers an attractive opportunity.